All right, so in this video, I'm going to talk about net present value. Net present value is the cumulative present value of all present and future cash flows associated with the capital budgeting project. And if you're going to find present value, that means you need a discount rate. So the discount rate we're going to use for net present value is the risk-adjusted cost of capital, or the required rate of return given the risk of the project. And that's going to be what's going to be used to find the present values of the cash flows. And ultimately, the way you interpret net present value is if the net present value is equal to zero, that means the project is just meeting the required rate of return. Project is not expected to change shareholder wealth. This is, in an economic sense, kind of equivalent to the idea of marginal cost equaling marginal revenue. It's kind of like I went out there and I acquired capital that I needed to get a return of 10% on. I got that capital and then I invested it in a project getting 10%. And the reason why this is sort of not essentially expected to help, I got the capital, it needs 10%, I'm getting 10%. Prior shareholders aren't better, aren't worse, right? So I didn't really enhance anything for my business here. Not worse, but not better. If the net present value is greater than zero, so positive, that means the project is expected to exceed the required rate of return. That means the project is expected to increase shareholder wealth, and we like that. So this would be kind of like if I went out there and I got capital that has a required rate of return given the risk of 10%, and I'm going to invest it in a project that I expect to get 15% at that level of risk. And so essentially I'm getting an extra 5% return. So I'm exceeding the required rate of return on this capital, and that's going to increase shareholder wealth. And what's going to happen is I'm going to get a positive net present value in that scenario if it occurs. Now, if net present value is less than zero, or in other words, negative, the project is lagging the required rate of return, and the project is expected to decrease shareholders' wealth. So this we would reject, and this would be kind of like a situation in which I go out and acquire capital with an overall cost of 10%, and I invest it in assets and investments, capital budgeting projects that are only expected to get a return of 3%. So if I acquire capital with an expected return of 10, I'm only getting the 3%. I'm 7% short. And basically the person who's going to make up the difference for that, because I got to pay the lender, right? So the person who's going to make up the difference for that is going to be the common shareholder. So I'm actually going to decrease my common shareholders' wealth when I invest in a project that has that negative net present value. So we want to be mindful of that. Now, let's talk implementation a little bit here. So I mentioned that the net present value is the cumulative present value of all present and future cash flows. So let's take an example, and I'm actually going to build off of the example that I did for the payback situation, also the discounted payback. So if I need to find the present value of all the future cash flows, let's take a look. Let's see what this would look like. So using that example from before, $100 spent in time zero is worth $100 at time zero. So that's already a present value. This was my present value this was my present value for year one, present value for year two, for year three, year four, and year five. And this is my required rate of return. So this was the section that I put together to find the present values for the different cash flows that we were expecting. These were the raw cash flows up there. So if I want the total net present value, basically what I could do is I could say I want the initial cash flow, which is a negative, plus present value for one, plus present value of two, plus the present value of three, plus the present value of four, plus the present value of five. And I hit enter, and I get a net present value of $30.71. So if it's $30.71, that's positive. I would expect that to increase shareholder wealth. Sounds good, right? Turns out there's a shortcut for doing this. So in Excel, there's a function. So we're going to do equals NPV. So equals NPV. The first thing it asks for is the rate. So I'm going to select the rate and comma. The next thing it's asking for is value one. Now, you need to pay attention with this. Value one means the value for the first period, not the first number you've got on your timeline. So I'm going to highlight all of these cash flows starting at year one and ignoring the cash flow at time zero. I'm going to close the parentheses, plus then I put the cash flow at time zero outside the parentheses. And let's talk about that for a moment. $1 at time zero is worth $1 at time zero. In other words, I don't have to do any time value of money or present value calculation with that $100 outflow at time zero, because that's happening today, and $1 today is worth $1 today. So I don't have to do any kind of calculation. $1 in year three is not worth $1 today, and that's why we had to do the present value calculation, or using the net present value function here. So when I go ahead and hit enter, Lo and behold, I get the same exact number. So if you're wanting to calculate the net present value of a series of cash flows in Excel, basically you just do equals NPV, you put in the rate, you highlight the cash flows from years 1 through the end of the project, close the parentheses, and then the year 0 cash flow goes outside the NPV function. And you don't have to do anything for time value money for that cash flow at time 0 because a dollar times 0 is still worth a dollar times 0. Okay, so with all of that in mind here, let's take a look at kind of what this means then. So in this case, we have a net present value that is greater than 0, so the project is expected to exceed the required rate of return. So in other words, we're getting a higher than 10% rate of return. In that example, I used a 10% cost of capital, so we're getting a higher rate of return than that. So we expect to increase shareholder wealth, so we would say we should accept that. Now, it's interesting to know that the net present value calculation actually assumes that reinvestment is occurring at the risk-adjusted cost of capital. And if you're looking at that and you're thinking, what does that even mean? Okay, so let's go back to the example here for a moment. So when I get this cash flow, this $20 at the end of year 1, that's due to the project, but I'm not going to just stick it in a jar. I'm going to take that $20, I'm going to invest it somewhere else. So net present value assumes that when I take this $20 that I get at the end of year 1, I'm going to invest it in a normal project, getting this risk-adjusted 10% rate of return. In other words, I'm going to assume I invested it in a project getting this rate. And if this rate is the normal rate of return that I require for projects of this level of risk, that makes sense as an assumption. And I'm going to do the same thing for each of these cash flows. I'm going to assume that I reinvested them at the normal going rate until the end of the project. So net present value is based upon the assumption that when I receive a cash flow, I reinvested it in a project getting a normal rate given this level of risk. So I invested at that risk-adjusted cost of capital. And that'll turn out to be important when we talk about the internal rate of return in a subsequent video. So let's take a look at this last little piece here. Net present value does tend to systematically underestimate the value of projects, though. And you might think, why would that be? Well, the reason why that's the case is because when I look at that net present value project, it's assuming that those cash flows are locked in for the next period, right? So if I got a 5-year project, net present value assumes these cash flows are the only cash flows. They are the ones. If once I found them, that's it. Those are the cash flows that are happening for the next 5 years. But in reality, couldn't a manager make some choices or change things 2 years into the project that might affect the cash flows later? And of course, the answer is, well, yeah, right. I mean, managers can make changes. Things could turn out to be a bit different. We make some choices halfway through. And in some cases, the ability to make choices partway through might actually make the project more valuable than net present value calculation would make it look. So in other words, if I'm looking at buying a piece of equipment, I can run the numbers for the net present value, and maybe I even get a slightly negative net present value. But if that piece of equipment makes it possible for me to change things much more rapidly in my business, even though I'm not planning to change anything rapidly in my business right now, if it gives me the ability to change things rapidly in my business, that might have some value. That might be something that could conceivably benefit me, maybe in a recession or something like that. So unfortunately, net present value doesn't account for the fact that you might change something later. You might be able to change something later. So it tends to, as a result, systematically underestimate the true value of projects, because sometimes there's some flexibility associated with a project. Net present value assumes that there's no flexibility that's possible later. So that's just something worth noting. Net present value is probably a little bit on the pessimistic side, just because it's not assuming there's any flexibility there. All right, hopefully this video about net present value has been helpful. Thank you so much for watching, and have a great day.